Disclosure: specific businesses and companies mentioned in this video are for education purposes only and do not constitute financial advice. We're not sponsored by any company mentioned in this video. We don't know anyone who would say no to having a little extra cash in their pockets. Think about the kind of freedom this extra money can give you. There are plenty of opportunities out there that in time can turn a little money into a solid income stream. If you already watched our previous video on understanding debts, how savers become losers, you understand how the rich use their money to buy income-producing assets like rental properties or other businesses. But what if we're not rich, yet we want to start our journey with the little extra pocket money we have right now? What asset can we buy? After all, we all need to start somewhere, right? Here are a few ideas of income-generating assets that you can buy with little money in 2022. We'll start from the most traditional low-risk asset classes, then go on to the higher-risk ones. Dividend-paying stocks. Dividend-paying stocks are probably one of the most traditional ways to generate passive income, yet many people still don't know how to go about investing in them. A dividend is the redistribution of profit from a company to its eligible shareholders. High-yielding sectors like banks, insurance companies, consumer staples, energy and utility companies can give you quarterly dividends anywhere between 4 and 6%. This is on top of the potential price appreciation that happens when you hold for the long term. This percentage return might not sound like much when compared to other assets that we'll uncover later in this video, but it's definitely a concrete investment option offering a solid gain, especially if the alternative is your bank's 0.75% interest saving account. There are two ways to go about investing in dividend-paying stocks. If you're not familiar with the stock markets, it's a good idea to contact a financial advisor to help you devise a strategy that works for you. If your financial knowledge is strong enough, you can also decide to do this yourself. If you want to further cultivate your knowledge, please see links in the description below for book suggestion on the subject. If you decide to invest in dividend-paying stocks on your own, there are many self-directed brokerage platforms that allow you to buy and sell stocks with no trading commission. Robinhood and Webull are good examples for people living in the USA, and Wealthsimple Trade is a solid option for Canadians. For American investors, you can Google search for Dividend Aristocrats List. You can get the list for free and also have the option to receive monthly updates of the list directly in your inbox. A Dividend Aristocrat is a company in the S&P 500 index that has paid and increased its dividend payment every year for at least 25 consecutive years. There are currently 65 aristocrats for you to choose from, giving you plenty of options. An example would be IBM Corp, whose dividend yield is at 5.10% as of March 2022. The company has been both paying and increasing its dividend payments for the past 26 years. The more years a company has in the dividend growth streak, the more reliable they are at continuing paying in the future. For those living in Canada, you can also Google search for Canadian Dividend All-Star List. On this list, you'll find the equivalent of the US Dividend Aristocrats counterparts. See the link in the description below for free resources on the Canadian Dividend All-Star List. Canadian company like energy giant Enbridge Inc. offers a solid 6% in dividend yield with 26 years of dividend growth streak under its belt. Take that 1% interest high-interest saving account. Spend some time researching the companies that you like and believe in. Investing in different companies from different sectors offers long-term benefits through diversification. Real estate investment trust, REITs. Do you want to invest in real estate but are not willing to take a mortgage out to buy your first income property? Then REITs are a great way to start dipping your toe into real estate investing. A real estate investment trust, or a REIT, is a company that owns or manages income-producing real estate. There are REITs for nearly everything. For example, apartment buildings, office buildings, hospitals, grocery stores, and shopping malls, just to name a few. As a REIT investor, you own a small cut of the property and therefore are entitled to receive dividends just as you would if you were a shareholder of a publicly traded company. A REIT does not pay corporate taxes and instead must distribute its profits back to shareholders. For this reason, REITs often have a higher yield than dividend-paying stocks. Another thing worth mentioning about REIT is that for the investor, they do not have the same tax implications as dividend-paying stocks. Because REIT doesn't pay corporate taxes, the dividend that you receive will be taxed as ordinary income, not as a preferential dividend tax rate. So if desired, you can delay your tax obligation or avoid paying taxes on your dividend and future capital gains altogether by investing in tax-deferred or registered accounts. There are the 401k and the Roth IRA in the USA, or the RRSP and the TFSA in Canada. Talk to your tax professional about different registered account options, or look at our reading recommendations in the description for a list of easy-to-read, plain English books on the subjects. Now that you know about REITs, do you wonder how you can start researching them? Great question. The answer is the same as dividend-paying stocks. Psst, if you haven't already downloaded the free Canadian Dividend All-Star List, you will see many REITs in the same spreadsheet document in the Main tab and Others tab. How convenient is that? For example, you'll find a diversified REIT like Firm Capital Property Trust, FCD-UN, trading only for $7.68 CAD, offering a 7% yield with 10 years in growth streak as of March 2022. Interest income from digital assets. It's 2022, and cryptocurrencies are becoming increasingly accepted by big institutions. Tesla went public about its Bitcoin investment last year, and now the Canadian big accounting firm KPMG is joining the team. Given their recent boom, Bitcoin and Ethereum sure seem expensive to most of us. Not to mention that the wild price swing happening 24/7 is a hard pill to swallow for those who are new to the investing game. Whether or not you should invest in BTC or Ethereum is debatable, and that would deserve a video of its own. But one thing that we must agree on is that blockchain technology and the development of Web 3.0 is here to stay. What if we tell you that there are many ways you can benefit from this emerging technology? No, we're not talking about becoming millionaires from holding Dogecoins overnight. We're talking about an emotionally sustainable, consistent, dependable passive income stream that you won't lose your sleep over. The passive income rewards percentage can be in the double digits, beating traditional banking out of the water. We're talking about earning interest income from our digital assets. There are many digital assets out there in the crypto space, but for the purpose of the video, we only want to cover the very basics here, the stablecoins. A stablecoin is a class of cryptocurrencies that offers price stability and is backed by a reserve asset. Stablecoins may be pegged to a currency. For example, the USDC stablecoin is pegged to the US dollar. Unlike Bitcoin, stablecoin like the USDC does not have a price fluctuation. It's very liquid, which means you can buy and sell USDC or transform it into any other currency whenever you want. You can then deposit your USDC into an interest-bearing account and start earning passive interest income from it. Depending on the fintech company that you decide to deposit your stablecoin into, the interest you can expect to earn on your deposited USDC stablecoin can go from 5.5% all the way up to 8% without the need to purchase any additional membership reward programs. Popular fintech firms that offer such interest-bearing account services on crypto assets are BlockFi, Celsius, Nexo, Crypto.com, and the Yield app. Yield app, for example, offers a base annual interest rate of 7% on your USDC stablecoin. A base return of 7% might not sound too exciting, especially coming from the crypto space, but the interest reward is paid every 24 hours and can be set to auto-compound daily. For those who understand the magic of compound interest, daily compounding is pretty amazing, completely unheard of in the world of traditional banking. You can also participate in the company's membership reward program, in which case you can earn up to 14% in interest on your stablecoin's deposit. Please note that the Yield app is currently not available for US residents. As you can see, there's a world of options out there. There are but a few that we shared with you today. If you find value in the content, please like, share, and subscribe. Let us know your questions or suggestions in the comments below, and see you next time.